Wessel, former Bay Street banking analyst and now head of Hamilton ETFs. And it's always great to have you here, Rob, on day one of bank earnings season. Thanks for coming in.
No, thanks for having me.
Let's begin with the CIBC numbers. What's your take?
Yeah, so it's only one bank, but about a month ago, we posted a piece on our website, HamiltonETFs.com, where we outlined opportunities and risks for the sector. The key opportunities we highlighted was first, would credit come in better than expected? And I think if you look at CIBC's numbers, it definitely did, and it stayed relatively benign. The second opportunity was that capital markets were cyclically weak. So it came off a couple of quarters where it was only $6 billion for the sector. They've gone as high as 7. They've been normalized at 7, and they could go as high as 8. Again, looking at this quarter, capital markets were much stronger than you've seen in the past. The third one, which is very important, I think, which unsettled the market last quarter, was net interest margins. So we thought that the NIM story, which the market was very optimistic about going into last quarter, was very disappointing to the market, but we thought it was somewhat obscured by trading. If you look at this quarter for CIBC, net interest margins for lending activities were actually up. So I would say the three things that the market cares the most about were broadly positive for CIBC this quarter.
This appears to be a beat driven by the capital markets segment, which you said came in stronger than expected. Mm-hmm. Does that raise this issue of earnings quality? And we saw profit actually come down in Canadian retail banking, U.S. banking as well.
Yeah, I mean, the segment disclosure is always a bit muddied for every bank, not just CIBC, so we don't spend a lot of time in the segmented reporting. I think we prefer to look at the overall bank. Okay. And it's true. I think anytime there's excessive trading, the markets asks that very same question, which is, what is the quality of earnings? And I think that's fair. Having said that, they beat by an awful lot. Yeah. But some of the other core drivers of bank profitability that the market does care about and does speak to quality, namely credit and net interest margins, were both positive. Now, did they kill it? No, but it was still, I think at the margins, given the expectations, we're still positive.
Let's speak more about provisions for credit losses. As we told our viewers, the direction of travel was up, but the number was not huge. $300 million, 295 to be specific, is not a huge increase in it is not a huge amount for a bank to set aside, given what we've seen in the past. We're going to get to this one in just a minute, this graphic that we're looking at right now. That's not CIBC specific, that's sector specific, and we're going to get there in a minute or so. Yeah. But you used the word benign to describe the credit experience at CIBC.
Yeah, I mean, I guess there's two ways of thinking about it. I mean, a recent credit rating report was saying Canadian bank credit quality was deteriorating. I guess another way of putting it is it normalizing? And I think normalizing is a better word than deteriorating, because where you're starting from is still cyclically low. So provision ratios are still well below long-term averages. And yes, are they going higher? Yes. Does everybody think they're going to go higher? Of course. The question is, are they going to go higher than market's expectations? And that does not seem to be the case.
Okay, so let's talk about the sector as a whole. Now we'll bring back that bar graph, which shows us the recent history of provisions for credit losses, including that enormous amount that they set aside in 2020 as the pandemic gripped the Canadian economy, as they got ready for an enormous wave of bad loans that never really materialized. So you'll do a better job of explaining it than I do. Go ahead.
No, I mean, so in terms of the note we wrote, we talked about the risks. One of the risks would be there's this amorphous accounting reserve that's new, this sort of new accounting treatment for this downturn, these reserves and allowances and provisions that you set aside against loans that are still fine. That number, the risk is that the banks look forward and say, we think the outlook is deteriorating, so this accounting reserve goes up a lot. It's by far the biggest contributor of volatility of earnings in this downturn. Nobody can predict what's going to happen with it, but this quarter for CIBC, it barely moved, but that's a very big risk. Is that, not a very big risk, that is our risk. Does this provision or allowance get built just even though it's accounting that it unsettles the market? And so far, that was not the case this quarter. It did go up, but not by enough that would disturb the market.
The bank shares did very well in January. We saw a strong rally in the bank shares. Some of your peers or former peers, I guess, other Bay Street analysts,
they're not peers,
are saying that rally went too far too fast. They think the share prices will moderate from here. Yeah,
so we'll talk about that a little bit more in the next segment, but I don't think there's any question that the banks were very, very inexpensive. When we wrote our piece, they traded at 9.1 times. Now they traded about 9.4 times. I think that's true. I think there's two ways of looking at it. What are the fundamentals, and what do you think is going to happen to the fundamentals? Primarily driven by what happens to the economy. So that story is yet to be played out. So I think right now, the people who are more I don't want to say bearish, but maybe more cautious, are likely building in what they think might be a more concerning economic outcome, and those people who are saying, listen, we're very comfortable with analyst estimates, and therefore we think the sector is cheap, believe that the analysts have more properly reflected what's going on.
Is there any reason to believe that the benign credit experience from CIBC in this quarter and the strong capital markets experience may carry forward to the other big six banks?
Yeah, I think that's likely. I mean, it's true. Like credit, I think is a more safe read-through. Capital markets, it can vary by bank, but I would say that it's likely that they're going to be higher, if only because, they've been very weak for quite a while.